Hello, my name is Casper Nyberg, and I am here today to perform a management analysis for Zoetis Incorporation. Quick introduction. Zoetis is the world's largest producer of medicine and vaccines for animals. That puts them in the pharmaceutical industry, and their main product then obviously becomes synthesized medicine. Over the year, they have had a net and total asset of $4.8 billion, which is an increase from last year by 12%. Zoetis' main competitors are Ingelheim, Elanco, and Merial. Now, Elanco and Merial, they are direct competitors because their main product is also animal medicine. Ingelheim, on the other hand, they are a substitute product competitor because they are dealing with diseases medicine for cardiovascular problem and for general stomach ache. Let's start it off with a horizontal balance sheet analysis that we conducted. The first thing we see, and the most substantial thing we see, is that cash, a liquid asset, increased 115%. So in 2016 to 2017. This huge increase of cash is very interesting to analyze because it comes at the same time that inventory level decrease. A probable cause is that sales revenue increased heavily and they have sold off a lot of their inventory goods. With this excess cash comes a lot of investment opportunities. The first thing you might think about is investing in the R&D department. I'm thinking in an industry such as Zoetis with pharmaceutical products. You want to have a good research and development program that can make new drugs, make new medicine that you can be forefront runner of, and that you can then get a patent on and sell off for further revenue. This is the first great way they can use that excess cash. However, a second one to prevent future risk is to invest in their inventory current level. 2 years in a row now, it's been decreasing, which shows that they are having a good sell-off, but they can't replace it. Maybe they need to do an acquisition with a vertical integration with a supplier because it's not good enough, or something in that style. But they need to look into their decreasing inventory levels. Next up, we have a vertical balance sheet analysis. And the most important thing we see immediately is that of all the total liabilities, long-term debt makes up 58% of it. Why is this a big problem? Well, it's a big problem because it's a non-current liability. It's not gonna get fixed over a year. It is gonna be there for a long time. And that's a weakness because you're not gonna get rid of it. It's gonna increase the interest over time. And it's gonna create huge cash problems that if it just piles up. Invest to reduce the interest. Invest to pay off some of that debt early on now while you have the excess cash. This means that you can get down and pay off the principal rather than just adding on to the interest payments. Lastly, we made an income statement analysis, and the balance sheet analysis showed a very strong trend. Good total assets increase, good liquid assets increase. Overall, the company is growing. The income statement, it shows some interesting things that we need to look at. The first one is the fluctuated net income trend. 2015-2016, Zoetis made over 140% increase in their net income, which is a fantastic number. But then 2016-2017, they only increased by 5%. First, we got to tell that the net income performance indicator shows that they're growing. The net income is increasing rather than decreasing. It's a good thing. However, why was it such a small difference 2016-17 and such a big difference 2015 and 16? Here are some contributing factors from that. First one, administrative expenses and general costs. Zoetis management must have done a good job between 2015 and 16 to reduce unnecessary expenses such as administrative expenses and general costs. Furthermore, they managed to reduce their cost of goods sold, which means that they could produce at a cheaper price. Obviously, they could then operate under a lower average total cost, which made them a way more profitable company. Maybe this management was brought over from 2016 to 2017 and they should carry on this trend. However, overall, the total performance has been very good for Zoetis. However, you can't put these numbers just like that up. You got to compare them to the industry ratio. And the first thing we see is that Zoetis, like we said, with inventory risk, is they have a low turnover ratio. It takes time for them to turn their inventory back over and get new, almost twice as much as the industry average. Compare that to how they are decreasing in inventory sales, how they need less and less days to hold their inventory. It's gone from 329 to 298, which you can tell that inventory is a future risk area, and that could be Zoetis' competitive weakness compared to other, that their inventory won't be big or strong enough to match future demand. Also, we want to look at the net profit margin, which has been incredible 49% compared to the industry average of 20%. This obviously goes to explain from the strong net income increase we talked about earlier from 2015. This shows that Zoetis' change in management from 2016 has really improved the company in general, and this is a competitive strength they can then use with their liquid assets investment or in other ways. Conclusion: there are four main points to push here. The increased liquid assets, cash has increased by almost 115%. You really need to use that money now to invest. That is the key here. The low inventory levels, that's the risk area, that's the weakness. They need to maintain that and look after it. Look for the trends. Maybe they can carry on for 2-3 more years, but then it could be critically low. Long-term debt, 58% of the total liability is long-term debt. Start with the investment you have from the increased liquid asset to pay that off. Come down to the principal quicker. And then the increased net profit margin, it shows that there might be small things to do, but overall, Zoetis is doing an excellent job. This has been all from me. Thank you for listening.